Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Hello and welcome. I'm Hayden Brain and you're listening to Opto Sessions, where we interview the top traders and investors from around the world uncovering their secrets to success. This week I spoke to Denny Fish, portfolio manager at Janus Henderson, an asset manager responsible for £272.5 billion of client money. Denny runs Janus's global technology and innovation strategy, a position he's held since January 2016, and combines those duties with his role as head of the firm's technology sector research team. Denny's fascination for tech stretches back to his time in Palo Alto, having worked for cloud giant Oracle in the late 90s. I asked Denny where tech stocks are headed next, with the market zeitgeist turning towards cyclicals. We speak about the innovative companies that make it into a fund that's returned nearly 50% in the past 12 months. And Denny finishes by highlighting his favourite tech innovations that are yet to make it into the public consciousness. Enjoy the episode. Hello and welcome to the podcast, Denny. Great to speak to you today. How's your week been so far?
It's been great. It's been great with never a dull moment in the market and earnings season coming up. So all good stuff. Thank you for having me.
Yeah, no worries at all. So I want to get started by touching on current markets before we dig into your background. So first of all, I saw the NASDAQ has lost or did lose 6% in September, which kind of piqued my interest because I guess you've got the peak at the all-time high on the 2nd of September, but then that narrative has somewhat flipped this month with the NASDAQ actually gaining. I mean, only around 3% when I checked just before this call, but it's still up. So in your opinion, and of course we're speaking broadly, where are tech stocks headed next, do you think?
Well, it's always difficult to predict what the next short-term move is in stocks. What I can say, though, is tech stocks, broadly speaking, depending on what part of the tech ecosystem you've been invested in, have had vastly different degrees of performance over the last couple of years, and particularly over the last 9 months or so as we've dealt with the pandemic. And I think we'll probably talk about this more in depth. But what it feels like to me, what we have a backdrop where there have been clear beneficiaries that have produced really strong results, and those are companies that were doing quite well before the pandemic, and the fundamentals of their businesses have only gotten better in many respects. That could be applied to the mega caps all the way down through some of the real secular growth areas in small cap as well. And then you have this idea of some, level of economic normalization, and this idea that at some point we should see the more cyclical parts of tech start to perform better. And then you layer on the election as well, and depending on the outcome there and what some of the actual impacts could be to financial results due to things like taxes, for example, and then kind of the less certain areas as to how areas such as regulation could potentially impact. And so there's a lot to unpack right now, but I think those two factors are probably the ones that are most at work right now as we think about the direction forward for tech stocks relative to the market.
Yeah, interesting. And I was reading before the call, I think it was a Financial Times article talking about the market zeitgeist sort of having turned towards cyclicals. And you mentioned cyclicals there as well. And I wonder a lot of our listeners are going to be in the retail space, some intermediaries, but for them, I wonder whether they should be looking more at the cyclical area of the market than they were maybe, let's say 1 month ago.
So, one thing that we do, we're secular growth investors by nature. You can see that by the construct of our portfolios. And we've invested for several years. But there's no really important nuance there. And the short answer is yes, there's definitely a place for cyclicals in a tech portfolio, and we invest in cyclicals. The way we think about cyclicals, though, are that looking at them business model first, meaning what are the absolute strongest business models that are most durable, and that while the businesses are cyclical, both the revenue profile of the business and the returns associated with the business, they're cyclical growth assets, meaning that through the cycles, you get higher highs, you get higher lows, both on revenue and returns. And so we really encourage investors to focus on high quality cyclicals, because through the cycle, those tend to be what I would argue is, whether we're comparing them to tech or whether we're comparing them to the broader market, those types of assets tend to put up better financial performance and potentially better returns than the broader economy that these companies actually sell to. And that's a pretty kind of like the pick and axe argument. And that's a pretty good place to be. So there's definitely a place for cyclicals in both tech portfolios as well as broader portfolios.
Yeah, great. And as you signposted earlier, there's a few key themes in there that I think we're going to return to, not in the too distant future. Hopefully, we'll spend a little bit of time on your background, and then we'll get into that stuff more deeply. But if I can focus on your background, particularly for any listeners that aren't aware of it and aren't aware of your work at Janus Henderson, when I had a quick look back at your career, you've been in the tech space ever since your role as technology sales manager at Oracle, having left that position in 2004. So has tech always been a passion of yours?
Yeah, it has. So, I mean, if we're going all the way back, I studied engineering at the University of Illinois, which is one of the top engineering schools here in the United States. And, shortly after graduating, I moved to Northern California. And the reason I moved to Northern California is because I wanted to, at that time, this is going to date me a little bit, but it was all about the, information superhighway and where we were going with the early days of the internet. And I wanted to be a part of that. And fortunately, I was able to get a role with Oracle back in the mid-90s. And it was a really important step, because I was infatuated by software and thought it would be just a great place to align my career for a multi-year basis. Oracle at the time was fighting what I call the database wars and winning those wars. And it was one of the businesses during the go-go 90s that actually was creating a really durable platform with great economics, and was creating meaningful market cap that, while everything got significantly overvalued, Oracle created a very durable business. And it was during that period that I really gained an appreciation for what we look for network effects and platform effects. And I saw firsthand the power of platform effects, where if you win software developers, independent software companies, and people that would write to your platform in a more pronounced way than the people you're competing with to dominate a market, you're going to win. And that concept has stayed with me. And then what happened was when the dot-com bubble burst, it didn't, nobody escaped from it. And I actually went back to business school and took a leave of absence from Oracle. So I was still employed with Oracle, but went to business school, got my MBA, and then actually came back out. And it was really when I got my MBA and kind of tied that together and said, I really want to be in investing, but came back and actually fulfilled my obligations at Oracle, continued there until I was able to actually transition to the sell side, where I worked for a firm called JMP Securities. And JMP Securities at the time was a small boutique, and they hired me to actually help with the software research effort, leveraging my background. And so I did that for I don't know, 3.5 years. And then fortunately, one of the best pivots of my career was in the mid 2000s. In 2007, I was actually offered the position to go to Janus and cover software IT services, for the entire firm, and then ultimately pivoted into the role as the tech sector head, and then ultimately running the global technology portfolio. And so it's been a really, I feel really fortunate to having been able to experience multiple cycles, start my career kind of in some ways on the front end of this 20 to 25 year journey we've been on, as Mark Andreessen calls software eating the world, and now sit here investing in many different subsectors of technology that have the same promise and opportunity as we look forward.
Yeah, and I was interested to understand, you mentioned a transition there. What led you to trade the sales role at Oracle for an investment-focused position as research analyst at JMP Securities? Why did you decide to pivot from Oracle to, as you described it, the sales side?
Yeah, it's a great question, because it wasn't easy, as you can imagine. I had a very good career. When you do something like that, you take a step back. And it's interesting because, candidly, I think about the opportunities that I had at that period of time. And, sometimes I kick myself because I could have been, early employee at Salesforce.com or worked for Adobe or places like that, and done, incredibly well based on the same trends. But there's an important nuance. I just loved investing. I invested my own money from day one, coming out of college. I always followed the market. I always followed stocks, mostly tech stocks. And I just had this passion. I knew that's what I wanted to do on a daily basis. And so I just felt like, it was kind of now or never at that point in time, I felt like. And so it was the time to make the transition, take a step back. And this is an important dynamic. I'll give this, shout out to a very good friend, but, the person who took, a shot with me. And that was a guy by the name of Pat Walravens, who was covering software at the time at JMP. And, he wanted to hire someone with industry knowledge and good analytical skills, and gave me the shot. And then in, quick order, created really good opportunities for me, and then supported me on my way onto the buy side. So it was there. It was just a passion. I knew it's what I wanted to do. And I knew from day one, I wanted to be on the buy side, not the sell side. But sometimes you gotta take, one step forward and be patient before that ultimate opportunity comes along.
Yeah, I completely agree. And I guess we've spoken about one theme that's followed you throughout your career, and that being tech. That's obvious, but maybe one that's slightly less obvious is research. When I was having a look at your previous roles and even your current role now at Janus Henderson as technology sector research team, or the lead of that team, it seems like research has been sort of prevalent throughout your career. Is that something that you enjoy? Is that something that you feel you're particularly good at?
Yeah, it's a good observation. And I think as it relates, the reason I love technology so much and I enjoy research so much is that you get to do a couple of things when you're looking at technology businesses. First, you assess the durability of the business model and competitive advantage, the potential network effects and unit economics of the businesses and all that good stuff in terms of coming to the conclusion of something is good business. And then secondarily, you often have the opportunity to go 2 or 3 layers deeper in terms of understanding what's really behind the business itself, and understanding the technology, and understanding how things are changing, and most importantly, where the sands are shifting because of disruption. And you put all that together, and it creates a really what I think is a unique environment to apply continuous learning and allow for a freshness in terms of thought that is really intriguing to me. I think there oftentimes are kind of two distinctly different camps in investing. And I think one is the type of investor that's constantly looking forward and trying to peek around corners and trying to understand a little bit more than maybe what the market does. And then there's a camp that's looking to find, just specifically things that that maybe don't change much at all, and are looking for very specific frameworks that you can put those businesses into to come up with a valuation. And so it we actually try to do a little bit of both of that, but we definitely steer more towards trying to figure out the future a little bit more than trying to assess what's going on at the moment. And I think that's the part of research that I think is most fascinating and why it's still a big part of what I do.
Yeah, completely. I mean, that's certainly the more compelling stuff, at least from my perspective anyway. And that was why we were so kind of happy to get a chance to speak to you today. And hopefully our listeners have kind of enjoyed hearing a little bit about your background and got to know you a little bit better. And that should put some of the content that we'll now go on to discuss in a little bit more context for them. So instead of return to current markets and current global equity markets, to be specific, the upcoming US election, you've already mentioned it. It's a massive macro event that will affect markets all around the world. But perhaps now more than ever, it looks as if it could be an inflection point for global stock markets. So in your opinion, how pivotal do you think this election will prove for the tech sector in particular?
Yeah, I think it depends on which sectors we're talking about. And so I'll frame it. I think if we start at the highest level, and I consider what we don't even call them mega caps anymore. We call them giga caps. And and that's, FANGMA. And for those that aren't fully familiar with the acronym, Facebook, Alphabet, Netflix, Google, Microsoft, and Apple. And if we think about that to start, the irony of what seems more likely than not at this point is a Biden victory and a potential what's called blue sweep. And so that potentially puts the Democrats in both the White House and then Congress and the Senate. And that's important, obviously, as you can imagine, for advancing political agendas that are aligned with the Democratic Party. And if we would have gone back 4 years ago, back to 2016, we would be having this discussion, and I would be a little more sanguine about just the negative effects associated with regulation, because it seemed as though the Democratic side of the aisle supported large cap tech a bit more than the right side of the aisle. What's interesting is as we've advanced the last 4 years and these companies have become bigger and stronger, and one of the reasons we invest in them is because they, for the most part, all have network effects and platform effects, and they just, as they get bigger, they tend to get stronger, which is really unique relative to tech, many years ago, where technology companies were more inclined to succumb to the innovator's dilemma and have more challenges as they got larger. And so as a result, and given a pandemic, there's just been, more scrutiny on both sides of the aisle. And there's, clearly the Democrats have suggested that they're going to be pretty aggressive as it relates to evaluating large cap tech. And so I do think there's both going to be a sentiment overhang potentially, just because that's out there. And I mean, for example, we wouldn't be surprised if the DOJ formally files its complaint against Alphabet within the next week or so. Could be a month, could be a week, but it's coming in short order. And, that's likely to be based on business practices associated with vertical search, as well as potential bundling practices of its apps with the Android operating system. And then so what we've kind of thought about is, like, we're looking at each of these large, giga cap companies, and stack ranking, who has real regulatory risk and who doesn't. And where we always shake out, we're like, well, Microsoft went through its existential crisis back in the early to mid 2000s, given Windows, the bundling of the browser to compete with Netscape, and ultimately ended up with a consent decree with the United States Department of Justice, and that was they would limit their aggressiveness in competition as it related to bundling. And the DOJ originally wanted the company broken into two companies, but Microsoft won on appeal. And so that's kind of an important thing to kind of put in the back of your mind in terms of potential outcomes. And but nonetheless, what that created what we call somewhat of a lost decade for Microsoft, because they were really hamstrung in terms of how aggressively they could compete in adjacent markets because of their accused anti-competitive behavior associated with Windows. And so we've kind of gone through all of them and, stack rank, each company, Microsoft having the least risk, and then, clear risk to, the others with Alphabet, as we mentioned. Apple has really come under scrutiny because of its app store, and that's really important because that's a big part of the story and the shift to services and the reason for the increased multiple. So any material changes there. We've seen the lawsuits from Epic on the gaming side, wanting to avoid the App Store payments infrastructure within its own ecosystem. Spotify on unfair, competitive practices. Match.com, similar to Epic. And so, we'll see how that plays out, but that could be material. You have Amazon, where there's an investigation going on around its practices with third-party sellers, and are they using data associated with their third-party sellers to advantage themselves? So that could have moderate impact, but seems pretty limited. Facebook's more of a content moderation and what's called Section 230 issue here in the United States around internet platforms not being liable for content, and could there be changes there? That would be pretty meaningful. But one thing that's clear is the government's not going to really allow scaled investments that are adjacent to its core social networking and messaging platforms. And if they would have had their way and they really had looked forward, they probably wouldn't have approved Instagram and WhatsApp at the time. So as we just go through those, we're just trying to handicap what's real and what's perception. And there's a very, there's also the dynamic too, is the U.S. government needs to be careful to not overstep and inhibit these national champions from continuing to compete on the world stage, given resurgence of companies in Asia, for example, in China. And so that's one dynamic that we think really hard about. The other dynamic is that, it does seem like there's now firmly support on both sides of the aisle for a more aggressive stance against China. But the Democrats are likely to take a softer tone, aggressive, but softer, and one more of trying to collaborate versus this up and down volatile embracement of trade tactics that we've seen over the last few years with the current administration. And so that's probably a little bit better for semiconductors, given semiconductors have felt the brunt of the ups and downs of this trade war for quite some time. I think that the markets probably, continues to be relatively unregulated in areas that are showing a lot of promise, and that continues to be, software companies, fintech. There's a lot going on right now as we think about the way that cash has moved around, and storage of cash and challenger banks and things like that. And so that seems like that's pretty low on the agenda, and we probably continue to see a lot of disruption there. But if I was going to characterize it, I would say kind of modest fundamental impact to the big platforms, a maybe a bit more of a tailwind to semiconductors. And then the one area that everyone will ultimately face if we have a blue wave in Biden is, a certain amount of unwinding of the tax benefits that the current administration had put into effect that took corporate tax rates down a lot. So that's probably one, but that's going to be pretty broad-based across the economy. And the good news for tech companies is, maybe it takes away a year of earnings growth, but in many cases, not even that. And you're back above normalized earnings despite the tax hit less than a year after that. And that's pretty special, actually. And that's one of the things that continues to separate tech from the broader economy, and that's just the structural growth of revenue, earnings, and free cash flow. So I know that was a lot, but there's kind of a lot to unpack in terms of what the impacts of the election could be.
Yeah, no, completely. And you've done a really good job of covering all the key points. And I was going to ask sort of to what extent it would have a kind of long-term detrimental effect on tech. And that's, Biden winning the election and coming into office. Like, will that have a detrimental effect on these companies in the long term? But I think you've broadly answered no, even though, of course, earnings could be hurt in the short term. And I guess when we say short term, we're saying around 1 year, for example. But I guess I wanted to move on to whether people listening in that do have tech within their portfolios, which near enough all of them will do, given tech's outperformance this year, in the run up to the election. Should they, and I want to avoid obviously giving people advice, but would it be a good time to consider, I suppose, the makeup of those portfolios and perhaps revisit the allocation to tech and their weighting to tech? Or do you think, broadly leave it the same because the long-term tailwinds for that sector are in place and there to stay?
I can't be in the business of giving advice, and I'm clearly biased because I run a tech fund. But what I can say is that, over just about every year over the last decade, there's been something, and particularly over the last 5 or 6 years, there's just been something that, whether it was going to be mean reversion of, growth to value, or whether there was something that with China that was going to impact fundamentals. And through just about everything, there's been one constant, and I think this is really, really important for people to think about, and that is technology as a percentage of the global economy has just continued to increase. And so if you're thinking about where you want to be positioned for a multi-year basis, you start with that simple premise. And if you start with that simple premise, I think it's hard to figure out what the next move is over the next couple of months or 3 months or 4 months, but stay grounded on the idea that this starts to happen. And I'll lay out a very simple framework for you. And this isn't mine. I wish it was. It's simple, but it's from a conversation with Satya Nadella, who's the CEO of Microsoft, who's effectively created one of the greatest corporate transformations ever in world history. And he's a fascinating human being, an incredible manager, and he lays it out pretty simply. He says, look, if you look at the global economy today, it's about $80 trillion in value. And of that $80 trillion, about 5% or $4 trillion is spent on technology or some sort of technology-enabled service. And what that equates to is not just IT spending, but what we call cost of goods sold and operating expense digital rents. And so you add all that up, that's $4 billion. And if you make the assumption that over the next decade, given accelerating trends along those lines and, a faster move to, digital from analog, like we haven't seen in a generation, is that it's not, out of the realm of reason to think that the percentage of the global economy that's digital in nature is, twice as much as it is today, meaning, it moves from 5 to 10%. That seems pretty reasonable. So if you assume the global GDP grows, call it 3% annually over the next decade, and you assume that tech continues to take share and ultimately ends up as 10% of global GDP versus 5%, you end up with a CAGR of somewhere in the neighborhood of 10 to 11% on the top line. And so if you're investing in the right businesses, that's much faster growth on the bottom line as well. And that's multiples of what the broader economy will grow at. And so I always look at that and I always think, sometimes I get the question oftentimes like, wow, isn't it really risky to invest in tech? And my response is, I actually think if you run the math on the way things are shifting in the global economy, it's really risky not to invest in tech. And so that's the framework that I use. And, really careful, given where valuations can be and what the backdrop environment could be that could impact financial performance or stock performance and sentiment in tech stocks over a shorter period of time, but really try to stay grounded on that idea and that concept. Because I reflect on what the world looked like 10 years ago in 2010 relative to what it looks like today. And it's amazingly different, and tech's only become more important, and we're still just kind of on the front end of a lot of different trends. So hopefully that's helpful.
Yeah, I think that's really helpful. A really sort of solid framework to start with when you're trying to make those key and sometimes very difficult investment decisions. And I think we're going to return to some of the specific sort of sectors and spaces within tech, which we've talked about quite broadly so far, later on in the interview. But perhaps we can do that via your strategy, I suppose. I want to get some detail on Janus Henderson's Global Technology and Innovation Fund, in terms of how the team identifies opportunities, selects equities within the portfolio, and then how you actually manage that product. But firstly, for the listeners that may not be aware of the fund, could you narrow it down to one thing or a mission statement? What's this fund all about? What's the key goal?
Yeah, the key goal is to apply a team-based approach. We have really deep domain experts that support the fund to drive returns for our clients, leveraging a collaborative, trust, and spirited debate environment to capitalize on this broader economic shift from analog to digital, and do it in a way that creates an all-weather portfolio effect through what we refer to as a combination of resilience and optionality. And that's really what we do. And we stay focused on that North Star, and we know what we are. We're business model first investors, and everything's built up one stock at a time. But we're extremely conscious of what we call the mega themes that provide the tailwinds for tech over a multi-year basis, and that's what we do.
Yeah, absolutely. And I want to dig into that combination, that all-weather aspect of the portfolio that you just referenced there. So essentially, you're balancing resilient companies with those with growth potential to give investors, I guess, that optimal mix of risk plus growth. Can you talk us through how you achieve that often elusive blend of companies?
Yeah, it's something that we've really operated within for many years. And it's this idea that through multi-year periods, the optimal way to construct a portfolio in technology is to do two things. One is to find what we believe are some of the best, most attractive secular growth assets that have created enough scale or competitive advantage and have enough growth ahead of them. But importantly, the durability of that competitive advantage, the position that the company has relative to its opportunity set, creates what we call a narrower range of outcomes in terms of just, how we have to think about those companies potentially being disrupted. And so if we can get to a point where we're really confident on the business prospects for the next 5 years, and we have a reasonable kind of view on what we think the range of the growth rates potentially are, and importantly, other ways that we think the companies can continue to add value, those are the types of businesses that sit in the resilient part of the portfolio. And I call there's this distinction I want to call out, because sometimes people will misunderstand our strategy for a value versus growth barbell. And it's far from that, because resilient companies can still have relatively robust valuations if the financial performance is expected to be robust, and we just have a ton of confidence in the outcomes of those businesses. And what we avoid is, as I mentioned earlier, mean reversion, or companies that have what we would expect to be challenged fundamentals over a multi-year basis. We try to avoid those types of businesses. So that's how I describe resilient. And then the balance to that is creating a portion of the portfolio, which could be upwards of half the portfolio depending on market conditions, or it could be as low as 30% or so of the portfolio if it's just we're in more extreme environments around valuations or lack of opportunity set. And that is creating optionality. And what we mean by that are companies that are earlier in their life cycle, companies that that share certain characteristics of things we've seen before that have turned into really meaningful investments and can be very additive to the portfolio if we just get more than half of them right. And so if we have a decent batting average on these names, just the way they can express themselves can add a lot to the portfolio. But by sizing them accordingly, what we do is we take some of the risk and the volatility out of the portfolio. And so our resilient names are much bigger positions. They could be 3 to 5%, or more, in the cases of some of the larger names. And then our optionality names tend to be less than 1%. But by putting these two, what we call kind of two portfolios in one together, and assuming we're doing our job right on resilient and outperforming the index, and then assuming we're doing our job right on the optionality portion of the portfolio, it does create this nice, kind of spring in the portfolio on the upside, and then it provides a degree of cushion whenever things get a bit more tenuous and you average it all out. And that's generally been a pretty good formula for providing investors with a portfolio that doesn't have crazy volatility statistics and has actually provided above market and index returns. And so that's our goal. And so that's how the portfolio construction philosophy has evolved. And there will clearly be markets where it is go, and if the whole portfolio was in more optionality like names, we would have done much better. And then there are clearly market environments that are the inverse of that. But we think the best approach is this balance of just really, really great businesses that can compound over many years, and then getting these optionality names right. And I do want to highlight another distinction too, is the way we've been successful with building the optionality portion of the portfolio is through leveraging the work that we've done with many of the resilient names. And I'll give you a really good example, and this will kind of highlight how we think and what we do. Is we've been investors in Adobe, Salesforce.com, Microsoft for many years, and all three of those were in Microsoft and Adobe's case. I guess they were all different. Salesforce is just it was kind of the first SaaS company to go public, and it created a completely different business model and technology delivery model, and unique value proposition to customers. But importantly, there was a really important dynamic, and this still holds true today, and that is the company's income statement has optically looked like it just didn't generate that high of returns, and its TAM is somewhere in the neighborhood of $80 billion. And so this idea that these market opportunities are always much, much bigger than what investors think on the front side. And so kind of applying that framework, that's how we build up optionality. And I highlight that because it's a real distinction between optionality and what we would refer to as gambling, where companies can go really, really fast, but their business models are fragile and they're likely to come crashing down at some point. And those are the types of businesses that we actually avoid. So, and so we think, that healthy balance, and as always, between resilience and optionality, putting that business model first lens and studying unit economics, and importantly, investing in management teams that we think are really innovative and drive experimentation in their businesses to create value well above anything that we can even anticipate.
Yeah, that's really interesting, and that example was actually really helpful to kind of make it real for me and hopefully for the listeners as well. We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show. I just wanted to dig into quickly an element of your process. I mean, you're talking about this optionality kind of section of your portfolio, and some of those companies are going to be particularly sort of innovative, maybe companies that some of our listeners haven't even heard of. And I wondered whether there's any specific sort of fundamental metrics, for example, that you're looking at to decide, yep, that's an innovative company that's going to form part of our optionality kind of aspect of the portfolio. Is there a smoking gun that says, okay, yeah, this is an equity worthy of further evaluation?
Yeah, I think what's really important for us in optionality is we're looking for companies earlier in their life cycle, but that can be big ideas. And we're not looking for small ideas that are going to compound around a narrower range of outcomes. And so we'll leave that to the resilient part of the portfolio. So it really is this idea of looking for companies where we can debate and do research and come to the conclusion that there are multiple ways that the companies can be meaningfully larger, and that their growth opportunities associated with their TAM, which is the total addressable market, are meaningful and long in duration, and quite likely underestimated. And then the other thing that we spend a lot of time on is we spend a lot of time on understanding the unit economics of the business. Because if there's one important, I think, element for investors to take away from my comments today is not to go out and invest in a bunch of unprofitable businesses, but many of the most valuable businesses on the planet today started out extremely unprofitable. But if you did the work into the unit economics on the business, you would come to the conclusion the companies are actually very profitable. And that could be either in the internet space, in terms of how valuable users become as they're engaged into the platform. We talk about a number of names there, on the kind of smaller side that we've invested in. Clearly on the software side, as I've talked about, and so these are just in a world where much more of the value is being developed in an intangible way. These just the lens that you put on these businesses has to be different. And kind of coming back to software for a moment, if you have a business that you're creating a recurring revenue stream with 5% churn and potential uplift in price, and don't even give them credit for that, you've created just the math as a 20-year revenue stream before it burns to zero. That is super valuable at scale and should throw off incredible unit economics. And so, understanding that is really, really important. And then, we apply that same lens to consumer internet names like we've invested in, and examples of that are things like Snap that we think have a really interesting model, and the unit economics have a lot of room to run given a pricing umbrella relative to what many of its competitors charge on ads and the evolving nature of the platform. Areas like Match.com, which is proven to be have really good unit economics in its business that weren't obvious early on, and then as I mentioned, many of these software businesses too. So it's this combination of, we want a really big market opportunity, we want a really good management team, and we want to be able to see some demonstration of the unit economics, but might not be obvious to investors at first glance. And one of the metrics that we try to use, and whether this is software, internet, or fintech, this idea of customer acquisition cost relative to lifetime value of the incremental user, bookings or revenue or whatever that might be, and evaluate that closely to come to some conclusions on what these businesses could earn. And that's a little harder. I mean, the physical economy, and when you look at things like semis, which are a great industry, by the way, and we invest in semis, and we're big fans of increased content over time, and increased silicon content. But those look a lot more like your traditional industries, the way you would put a lens on, an industrial or an automotive company or some other, asset-heavy business. Other than the fab-light models that use Foundry, which look a little bit more like IP-based companies. If you look at an NVIDIA income statement, for example. And so, that's the approach that we take with optionality.
Yeah, and I wonder, this could be an unfair question, but is there a favorite, might be the wrong word, but a stock that particularly interests you at the moment that doesn't form a massive part of the portfolio at the moment because it's maybe a smaller business, a lesser known name, but one that you think some of our listeners might not have heard of that, as I say, particularly sort of interests you at the moment?
Yeah, there are a lot actually, because if we could go through our optionality portion of the portfolio, but I think a name that I would call out that is particularly interesting to me because of a number of factors, and as we think forward, it's been an incredibly good stock, but it's called Atlassian, and Atlassian is a really fascinating company because on two fronts. One is we firmly believe, so estimates out there that there are approximately 50 million software developers in the world today. And what Atlassian provides foundationally is, its core product is a collaboration and project management a suite of products for software development specifically. And there's a lot of workflow associated with that and collaboration, and it's really easy to use. And it's been virally adopted by software developers worldwide over many years. And importantly, what the management team did early on is they created a business model which was really the antithesis of what we'd seen from most software companies. And that is, they went with a low touch viral distribution model, where the product would be distributed as widely as possible with a pretty low price point that would give them a long runway to potentially increase price over time, but more importantly, break down the barriers to adoption of its software. And it's been really, really successful in doing that with this product, this core product, Jira, that they have. And then what they've been able to do is layer on multiple products over time to enhance that value proposition. And now we're just in the early stages of the company taking that same software and idea and starting to penetrate lines of business and other parts of corporations that could benefit from the same types of philosophical challenges that software developers face as they organize workflow. And that could be HR and onboarding, for example. It could be financial close process. And so we just look at this like continued really long duration opportunity around collaboration for software developers. We look at like a really unique business model, and then we look at the potential for this business to continue to grow within line of business applications, within organizations, and just continue to be excited about it. It's a really good example where, maybe some of the most powerful opportunities are you have kind of a new way of looking at an old problem. You have a secular tailwind at your back. You have a technology advantage, and then you also have a go-to-market advantage relative to your competitors, and you add all those things up, and it creates a pretty special business. And the company has just a really fascinating management team of two fellows from Australia that are just about as down to earth as it gets. They've created an incredible low turnover culture where people just want to win, and they're constantly experimenting with their business, which is what we love to see. And so those are the types of businesses that we really get excited about. So Atlassian's when I would call out, and a lot of people haven't heard of it because it's based in Australia, but it's dual listed here in the U.S. and has roughly I think a little bit over a $40 billion market cap at this point.
Yeah, that sounds about right. Yeah, it's fascinating actually. It's a company that CMC employees know particularly well, as it's a product that we use. We use Jira anyway. So. Yeah, so it's interesting that you called that one out, actually. So I've got two more questions because I've already taken up way too much of your time. So I've got two more questions before we move on to the quick fire question round, which should only take a minute or so. First off, you mentioned semiconductors a few times now. And when I was looking at the portfolio before the call, I did see that a collection of names, including ASML, for example, represented, I think, over 9% of the portfolio. I could have got that wrong, but a decent chunk. So could you just give us an idea of why you're particularly bullish on the semi space right now? What excites you about the industry currently?
Yeah, I think two things. I mean, if we're looking at semis, there are subsets of semis, and I would say there are three areas that we're actually comfortable with and excited about over a multi-year period. And a number of the names that you mentioned will fall into these categories. One is we continue to think we're just really early on in silicon intensity across the economy, and that's going to benefit kind of two sets of players at the chip level, and that are those that are powering the cloud and data centers and so forth that have competitive advantage. There's a lot of commodity players in there that we avoid, but more of like the durable players with meaningful competitive advantage, like NVIDIA, for example, or have a long runway of growth ahead of them. And then the analog. I know I talk about moving from analog to digital, but there's this concept of analog semiconductors, and importantly, they kind of operate a little bit like digital in that they're very important parts of the physical economy that have really long duration product cycles and really long life cycles, and the businesses actually look outside of the capital intensity a little bit more like software businesses if you actually look at the returns in the businesses and the long duration nature of the products, and so we get somewhat attracted to those, and that would be Texas Instruments, for example, as you highlighted, and so that's why we've invested there. And then we also feel like the best way to invest in the leading edge is to invest in companies like Semi-Capital Equipment, where these companies effectively have either monopolies in the case of ASML or kind of natural monopolies in their swim lanes, like Lam or KLAC, that aren't really fast growers, but they're clearly cyclical growth assets if you just look at the nature of their revenues and margins over the last several years. And so we feel like that's a good place to be. What we avoid in semis is we don't try to play product cycles. We don't try to invest in companies that maybe are doing really, really well because they want a big socket in the iPhone or with one of the cloud providers now at this point, which we're starting to increasingly see. Because as easy as you win one of those cycles, you could lose one, and lose meaningful parts of the value. And so that's how we think about semis.
Yeah, that's fascinating. And we've kind of jumped around the whole sort of tech world. We've talked about software, for example. We've talked about semiconductors there. But I wonder whether there's an industry or even a sub-industry or a theme that, although it doesn't command a large weighting within your portfolio right now, or doesn't command a lot of the public interest because maybe it's something that's relatively unheard of, but it is growing in importance. Is there a theme or a sub-industry like that you could name, that you could call out for the listeners?
Yeah, it's a good question. And sometimes there are themes that are pretty obvious to us, but there aren't a whole lot of ways to invest in them at the moment. But we're finding ways, and there's going to be a lot more coming over time. And I guess there are two things that I would highlight. The evolution of artificial intelligence and machine learning. The genie's out of the bottle, and whether these are companies that specifically are benefiting from playing, firmly in the idea of applying artificial intelligence, for example, to, workflow processes or something like that. It's going to be embedded in just about every company. Google's already redefined its, brain rank search algorithm now around AI, and it's going on everywhere. There just aren't obvious ways of where, we can invest, but we're finding opportunities, and we're also excited about a number of companies that'll be coming to the public markets over the next few years. And then, virtual reality and augmented reality. I mean, it's sort of underperformed, I think, investor expectations for several years, and there's still a fair amount of skepticism. But I think if we look at the way that companies such as Snap, for example, as I talked about earlier, and what they're doing with their lens product and some of the unique, attributes of a camera, and how you can create really unique use cases around augmented reality. Apple having, putting LiDAR in its most recent phones that were announced yesterday around, and that's firmly in the idea of being able to create more augmented reality use cases over time. And so I think that's going to continue to be a theme, and that plays into gaming, and there are like a whole host of things that we haven't been able to touch on, but those are some of the things that we get excited about over a multi-year period. There just aren't that many ways to invest in it directly at the moment. The third example that I would give is around the fintech and the disruption that we're seeing to the global banking and financial system. And I think it's a really important one because the way that money is actually being captured, the way it's being shared, the way payments are evolving, it's evolving in a way that's uniquely different than prior generations. And if you survey millennials and Gen Z, they tend to have a higher degree of trust of large tech companies, or even digital institutions than they do of more traditional banks that are used by their parents and their grandparents. And that has pretty profound implications over a generation in terms of where those assets sit, who's going to be most well positioned to sell those types of individuals and those generations financial products, everything from insurance to wealth management to retirement services and so forth. And so that's going to be another really, really big opportunity for investors as well. And that is firmly within the context of fintech and and disruption that we're going to see there.
Yeah, absolutely. And so interesting to talk to you at a time where we are kind of on the cusp and on the precipice of seeing such fundamental disruption and fundamental change. And I think that's an excellent point to leave the main body of the interview there. And I'll just quickly fire through our quick fire questions, if that's all right with you. So
sure.
It's simply a light-hearted way to end the episode, and you can answer in as little as one sentence or even one word, if you like.
Sure.
The first one, what is the top mistake investors make?
Thinking too small.
Yeah, I've heard similar answers actually. Yeah, I think that's a really good one. And question 2, where do you go for investment or economic insights? Are there any specific publishers you read, for example?
Actually, more and more, I use Twitter because there is an amazing group of individuals globally that have really unique insights, that are very open to sharing those insights and looking for people to debate with. And I find it just a great platform on the margin to use. And that's part of the idea of trying to become an industry participant in just about every area where we invest. And it's really unique because you get this combination of people that are investors, and that's what they do full time, and people that are practitioners, and that's what they do full time. And you can garner some really interesting insights from the platform.
Yeah, absolutely. Question 3 then, what's the most memorable moment from your career to date?
That's actually a great question. And maybe it's because it's fresh in my mind, but unfortunately it was earlier this year. And I only say it because we faced an environment where the market lost more value in a faster period of time than it ever had in history. And it was due to an event that was immediate and required a degree of decision making like we've just haven't seen. I mean, if we go back through other crises, like the global financial crisis, it was what I refer to as a slow moving train wreck. Ultimately, like the old quote for bankruptcy is it happens really, really slowly and then it happens really, really fast. This was different. Even the dot-com bubble, there were kind of fits and starts and, as things really slowed down, but there was time to assess it. There was virtually zero time. And so you really had to think hard about who was going to benefit, who was really going to feel the pain, and how you wanted to be positioned for a really wide range of outcomes on the economy and to business models and so forth. And so that was, I think that one tops them all. Kind of.
Yeah, I don't think you're going to be the only one saying that either. Yeah, absolutely. All right, well, our final question then, and it could be an unfair one, but I'll ask it anyway. What's your biggest source of alpha? And by that, I mean, if you had to narrow it down to one thing, how are you able to outperform? What gives you that strongest sense of alpha when you're investing?
Yeah, I really do think it's being a deep industry participant, because it gives you confidence to trust your instincts, to get behind ideas that aren't always comfortable. And I think investing in technology and in disruption, there's always this balance between excitement in terms of the opportunity and the discomfort of the uncertainty and sometimes the valuation that you have to pay in the near term to be proven right over a multi-year. And I would say striking that balance is what's helped me professionally. And the other thing is, I think what's really important to successful investing is that you're learning every day, and what worked for you a year ago might in concept work going forward, but there's always nuance and change and adaptation and evolution. And there are a lot of really smart people out there that you can learn from, and it's important to understand that and stay humble and not get too caught in your ways, and always be open-minded, but have a very disciplined process by which you operate within.
Yeah, absolutely. I think really solid advice for anyone listening. Okay, well, I think we should wrap it up there. It's been incredibly interesting talking to you, Denny. Thank you very much for joining us on the podcast.
Yeah, this was great. Thank you for having me, Hayden.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.